On your latest deal, was this your first A class property, or were some of your other purchases also in that same realm?
So up until that point, we had not purchased a Class A property. So that
Okay.
was our first Class A project that we purchased, and we had made the pivot and the decision to add the Class A asset to our portfolio in the beginning of January. So that was our first kind of foray into that Class A market. So there was a lot of different things that were worrisome or causing anxiety, if you will, at the time when we were doing that deal, because number one, it was an asset class that we had never been in before. So
Yeah.
investors, we had kind of I want to say primed them, but we had educated them a little bit as to why we were going into that type of a class. And so we used that newsletter that we printed out, right, to send to them to kind of educate them on that stuff beforehand back in like December and January. So they kind of knew we were looking for that and they understood, why we were doing it. So we knew we had educated them a little bit. But then we, of course, didn't know how much of an impact that was going to have. And so we have kind of prepped them a little bit on that, but it was our very first Class A deal. So and not only was the first asset class, but it was the highest raise that we had ever done as well.
Yeah.
And it also was the first time that we did a dual tiered structure for the LPs, where we had a Class A at a 9% and a Class B at a different percentage that allowed us to be able to give investors options as to what they were going to choose to invest in.
How, in terms of, you just talk about, you broke out that first structure. So how, I mean, obviously you guys raised a ton of money, so I assume it was well received, but was that something that a lot of people were, really attracted to, and they put everything in that, I forgot if it was a 9 pref or whatever, I don't remember the exact returns, but did they kind of blend the two, or did most people go to the straight, 8-9% return, or what was the investor sentiment towards that split?
Well, we had, again, educated them ahead of time, right? So anytime we do something new, we try to educate them ahead of time so that when they see it, they kind of already are aware of it. We educate them on what those preferred returns are, what's the difference between preferred returns and preferred equity, and what's a capital stack, and explain to them what position in the capital stack they need to be in. And because there's a lot of confusion about capital stacks too. I mean, you probably have heard sometimes, and I know I have, that, it's better to be at the top of the capital stack, but people don't realize that stacks are built from the bottom. Like, you've never built a Lego tower from the top, right? You always build it from the bottom. So the debt's always at the bottom, then the preferred equity, and then you're going to have your common equity along with your GP shares as well on top of that. So it's built from the bottom up. And so that we were all on the same page. I wrote an article about it, right? And so I would say that I think that was definitely another impact on the unknowns, because although we're in the middle of COVID-19, so that was the biggest factor. COVID-19, dual tiered structure, highest raise, new asset class. So everything was going against us as far as that is concerned. So I think there was definitely an educational piece to that helped the investors understand it a little bit more. But I wouldn't say we had a big, like, all in one or all in the other. There were a few that did the hybrid. Obviously we filled up the Class A investment side of things. Usually, I think on that one we had like a 35% of the capital stack that was for Class A, and the other percentage was for Class B. And then the Class B usually is the one that fills up the most. The Class A is the one that might take a little bit longer, but it usually fills up.
Awesome.
But I will tell you that entire deal was the most stressful deal I think I've ever raised for, next to my very first raise, because the very first raise that I did was only $2 million, a little over $2 million. It was like $2,025,000, and it took the full 60 days to raise that money. Right? It was very stressful because we didn't really have a big investor base at that time. Now on this deal, it was stressful because of all the different things I just mentioned, and we didn't raise the money within 2 weeks like we normally seen in the past because of all those different factors, primarily I think because of COVID. And we actually finished raising on that deal on the 59th day, and we closed on the 60th day on that one.
Wow, that's crazy. So now that you've got a taste for A-class properties, is that what you're looking to pursue more of in the future, or are you still looking at A, B, and C, or what's kind of the outlook for moving forward now?
Sure. So we're definitely not looking at the C class or the lower end B class properties. But what we're looking for right now is two different types. So we're looking at the B plus with value add, and then also the A class properties. Now when you talk about A class, a lot of times we kind of get in our head, because I used to do this too, is like, I don't want to buy A class because the rents are just way so far out of reach of everybody, right? And it's when you go into like a lot of the urban kind of infill areas where you have a lot of these kind of mid-rise or high rises, you're going to get those higher end rents where they're paying, $4, $5, $6, $7, $8,000 a month, depending on where you're located. And I would agree, you're outpricing yourself, and people are going to leave those and kind of go out to the suburban areas. We look for a suburban class A. So in a property that's already fully leased up, it's cash flowing day one, it's stabilized, and the average rents are anywhere between $1,300 to about $1,600, $1,700 a month. So it's not that much of a delta between the class B plus and the A class in that market, where you're going to be competing on that much of a delta in the differential in the rents.
Yeah, makes sense. So moving forward as well, where do you see the biggest risk kind of on the horizon right now?
Well, I don't know if anybody can really know for sure, because there's just so many different factors that could go on. Just yesterday, our attorney called us today, and just yesterday, I don't know if you guys saw this, but the CDC just put a moratorium on evictions across the entire country between now and the end of the year. Do they have the authority to do that? I would say no. Which our attorney is already. He's actually one of the attorneys that works with the National Apartment Association and NMHC. So they're working very closely on that situation to hopefully mitigate that risk. But so there's obviously risks of potential inability to evict residents that are not paying their rent, which is it's hard to stomach, but that's one of the risks. And then I would also say the unknowns of rent growth, right? So right now we don't really know where rent growth is going to go. The markets that we're in are already seeing an uptick in rent growth since I don't want to say we're on the other end of COVID, but we're on the other end of where we were in the beginning of COVID. Nobody really knows where we are. Are we in the beginning? Are we in the middle? Or are we at the end? Right? I hope we're at the end, but since when COVID-19 first hit, there was negative rent growth in a lot of the country, and right now it's started in this third quarter to start to tick up a little bit, which is good to see. But there's still unknowns of how far rent growth you're going to be able to push in the markets that you're in, and then also when you're underwriting, one of the hard things to underwrite for, which is a big risk, is where you might have originally underwritten for 12 to 18 months of stabilization during renovations, not stabilization, but doing your renovations and at least those back up, it might be closer to 24 months, right? 24 to 36 months, depending on where you are. So, and I also think from an underwriting standpoint, you have to mitigate some of that as well, where you're extending the renovation timeline, but you're also extending or increasing the vacancy rate during the renovation phase, where you might have originally been 7, 8%. Maybe you need to go to 9 or 10% at this point to kind of mitigate some of that downside risk. So there's a lot of risks out there, a lot of different pieces of that puzzle, especially from an underwriting standpoint, that can cause different levers to be pulled. One of the things that we're seeing right now is that obviously, cap rates have stayed pretty stable, and the majority of the more stable, primary markets, and some of the higher end secondary markets, and it's primarily because of the debt, right? The debt right now is so cheap. We're getting term sheets right now for the green loans for 2.5%, right? And I even saw one the other day at less than 2%. It was like I got to like 1.8%. And I was like, you got to be kidding me, right? But that's what we're going to be seeing, and the Fed is basically saying that they're not seeing in the foreseeable future, until probably 2022, for them to even revisit the idea of increasing the interest rates or anything like that. So that's going to be a big question mark, and also going to be a big factor, especially when you're buying right now at 2.5% interest rates, and then when you go to sell, where are you going to be able to? Where are the cap rates going to expand in a couple of years, or is the market going to improve and it's going to kind of level itself out? And you'll be able to sell at the entry cap rate. Obviously, when you're underwriting, you got to make sure that you mitigate that, and you try to model it where you have some sensitivities for exiting at a higher cap rate, so there's a softening of that market, just to have some additional conservativeness in that model.